Hello, it's ChewDog Charts, and today I'm going to bring something to you that I hope you find interesting. In the market, when watching the television, reading the news, watching YouTube, or even on the radio, we hear and see opinions about the stock market of every kind. On one end, we have those that are saying we're going to have a major crash. And on the other side, we have those that say that in the next year or two, we have a perfect market and there's huge upside potential. Well, I'm going to bring you two different arguments on each side of the spectrum. On one side, we have Tom Lee from Fundstrat Global Advisors. And Tom Lee is saying that the market has gone parabolic, but that is a bullish signal for the rest of the year. And on the other end of the spectrum is Bank of America, which is warning of a major pullback here very soon. I'm going to present the information to you in the best way possible and in an unbiased manner. And then you will be the judge. So let's take a look. Less than a month into 2018, strategists at major Wall Street firms, including UBS, have already raised their year-end stock market forecasts. And just in 2018, we have seen the S&P 500 gain 6.7%. According to Tom Lee, as you see here, the co-founder of Fundstrat Global Advisors, we attribute this parabolic rise to the strengthening confidence and rotation away from negative rate bonds, of which 20 trillion is still outstanding. According to Mr. Lee, this is a bullish signal for the rest of the year. He noted that previous rallies this big and at similar times were often extended. The S&P 500 has gone nearly 400 days without a 5% drop, the longest streak ever, with the last such drop happening when Britain voted to leave the European Union in June of 2014. So let's show you what Mr. Lee's opinion is based on. And this is the first chart forming the basis of Mr. Lee's opinion. And according to Mr. Lee, a parabolic move happens when market returns accelerate over these three periods. And this chart here is from, say, mid-2016 through January of 2018. And the three periods are shown as A, B, and C. And in the first period, A, which is from January 2017 through September of 2017, the average monthly return on the stock market was 1.24%. And then into period B, the stock market accelerates, and it did that from September 2017 through December of 2017, and the acceleration was up to 1.98% per month. And then in phase C, which is from December 2017 to January of 2018, which is the parabolic move, you can see that the acceleration was up to 6% per month. And then into these charts here. And there are 8 charts showing the various cycles and the acceleration, the parabolic accelerations in January of each cycle. And in 6 of the 8 cycles, the stock market was up higher measurably. And in the 2 cycles that the stock market was down, which was in 1929 and 1946, Mr. Lee argues correctly that even in those cases, the stock market following the parabolic move was also higher prior to the stock market crash. Now, according to Mr. Lee, to profit from this trend, if it repeats itself, he's recommending cyclical market sectors, specifically industrials, computers, resources, American banks, and phone and cable companies. So take a look at this chart for a little bit longer, and then we'll go to the argument by Bank of America. According to a recent report by Bank of America, they are warning of a market pullback. Reportedly, the record pace of money flowing into equity markets has triggered a strong sell signal for analysts at Bank of America. In a report titled Nonstop Euphoric Cabaret, Bank of America analysts say their sell-off indicator shows that stocks are very likely ready for a fall. They noted that the historical average to peak trough drop in the S&P 500 was 12%, and the metric known as the bull and bear indicator rose to 7.9, its highest level since March 2013. In contrast, the measure showed a reading of 0 in February of 2016. According to Bank of America, the culprit may be the slew of cash sloshing into the global equities. Bank of America observed an all-time high of $33.2 billion inflowing into equity funds this week, a record $12.2 billion with inflow to active funds, $1.5 billion into gold, which is a 50-week high, and record inflows to tech and treasury inflation-protected securities. They also noted its measure of private client equity exposure rising at its fastest pace in 10 years, cash allocation at record low, about 10%, 98% of global equity market trading above 50 and 200-day moving averages, which are also significantly high. And these warnings come as some fund managers who say that now may be time to hold some cash. There is another far more important reason why the triggering of the bull and bear indicator is a remarkable event. According to Bank of America backtesting, not only does this particular indicator also have a 100% hit rate once triggered, but on 11 out of 11 signals since 2002, the market has dropped an average of 12% after it was triggered. It also works in the opposite direction. The last bull and bear indicator flashed was a 0 signal on February 11th, 2016. Since then, the S&P has been up 22 of the next 23 months. Finally, and most importantly, unlike other bear market indicators which confirm if a crash is imminent, but not when, this bull-bear indicator gives an explicit time window. According to Bank of America, the market always drops within the next 3 months once a sell signal has been triggered. So we have that to look forward, according to Bank of America. So now it's your turn to decide. Do you think that Mr. Lee of Fundstrat Global Advisors and his acceleration charts in 3 phases, A, B, and C, and the 6 cycles out of 8 cycles showing continued appreciation is the better argument? Or do you believe in Bank of America's bull and bear indicator showing 7.9? I'd like to see your comments following this video. So for today, that's ChewDog Charts. Thank you.